Sonal Varma, India Chief Economist at Nomura, joining us all the way from Singapore. Sonal, hi, morning. Good to have you on the show. Now, Sonal, you yourself have flagged off numerous macro headwinds facing the India growth story over the next couple of years. Which of these, in your mind, would you rank as the most significant? And if you could elaborate on the finer points as well a little bit.
Hi, good morning. So the biggest issue, I think, for India is really the balance sheet issue. Because it's not just about the last 12 months of economic slowdown. I think we essentially, if you step back, for the last 5 to 10 years, as you know, private investments have been extremely weak, and that's partly a reflection of the weak balance sheet of banks, of companies, and sort of various other factors. I think what is different this time around, the slowdown we have seen, is really the non-bank sector, the shadow banks, which had stepped in back in 2016-17 when banks stepped out, are clearly no longer in a position to, are in a pretty dire shape, and banks are no longer in a position to actually step back in. So the basic point, I think, is that the balance sheet issues, which so far was confined to companies and banks, i.e. a twin balance sheet problem, has now become a triple balance sheet problem between companies, banks, and the shadow banks. Now, India is sort of more like Europe in that it's more a bank credit-driven economy. It's not like US, which is more a capital markets-driven economy. So if credit flow in the system, is constrained, and I think it is still quite constrained, it does raise a question of what exactly is going to drive growth. My other concern would be that, this process of balance sheet deleveraging that we've tried to do for the last 3-4 years, when you are in a cyclical slowdown where capacity utilization has come down, the prospect of demand recovery and the time it will take to deleverage the balance sheet actually gets pushed out even further. So I think the risk for India essentially is a fairly prolonged period of bottoming out process. The timelines for the private investment cycle to pick up get pushed out even further. And because that is a key ingredient into assessing the long-term trend growth for any country, I think the risk is if this does not get reversed quickly, the trend growth estimates will actually come down even further. So this is actually the biggest concern to our mind.
According to your report, we were just going through that. You're saying that the eminent slowdown will lead to a compounding effect and pose increased challenges to the economy. Specifically, how much can this potentially delay deleveraging target, and what will that in turn do to liquidity and credit within the system?
I think most of us were in any case expecting the process of investment and deleveraging cycle to not pick up anytime in the near future. I think what this entire process of sort of, like I said, lower capacity utilization, lesser visibility on demand does is there will be spillbacks into the economy. So when you have a weaker economy, if the NBFC sector was lending to specific SMEs and real estate developers, there will be, worsening in their credit quality and asset quality cycle, which will spill back into the system. So the bigger issue today for India is really one of credit risk. It's no longer actually about liquidity because there is liquidity for those that want liquidity. But I think because of the economic slowdown, the credit risk perception in the minds of investors and lenders has increased. So to your question of how long will this take, the entire deleveraging cycle, it looks to us it could take at least another 12 to 18 months to actually get out of this, if not much longer. And I think we need to be very careful about distinguishing between sort of a growth cycle recovery versus a long-term trend. Because, if the next quarter, let's say the September quarter GDP does fall below 5% as we expect, one would expect from a 12-month forward-looking perspective that, the rate of change will increase purely because you've hit a trough on the growth rate cycle. And of course, monetary policy has been eased, liquidity is positive, which is leading banks to, for instance, chasing some of the retail lending. So some of the discretionary side of consumption could bounce back in 6 to 12 months. But I think we could still very much be in a period where the longer term investments are still moderating. And I think that's really the bigger challenge.
Sonal, I hope we don't go below 5%. But if I look at the realistic lay of the land, are you being optimistic when you say that we've hit an economic trough? Because the capital formation from corporates is not happening. Big sectors are not drawing any fresh commitment, whether it is telecom or power or for that matter road. So for capex cycle to pick up, there has to be a proposition for corporates to spend. They should feel comfortable about equity and they should feel comfortable about safety of the capital. That is the missing link.
It is absolutely the missing link, and I think the more sort of high frequency indicators we've got for the month of October actually do not suggest that the October-December quarter is going to be significantly better than the September quarter. In fact, on an average, we're expecting the growth rates to remain around 4.2 to 4.7% range in the near term, and I would not really call it an economic recovery. I think, for India's size and potential, that's a very suboptimal growth rate to have. In fact, for the next 12 months, we think growth is going to actually remain below potential. When we talk about, growth bottoming out, like I said, a lot of focus tends to be on the year-over-year number. But I completely agree with you. I think it's really the longer-term trend and the longer-term investment outlook which matters a lot more. And when you have the capacity utilization coming down, lesser visibility on demand, debt clearly an issue, availability of credit clearly an issue. The longer term outlook really deteriorates, and that is a concern.
Sonal, so do you feel then, given the factors that you've outlined, that we're in for single-digit normal growth, so to speak, over the next 2 to 3 years? Is that the reality that we're facing?
Well, single-digit, of course. I think one is the global context, because currently we also do have US and China slowing down. And if we do see some pickup in global demand in 2020 at the margin in the second half of 2020, that could be a potential tailwind. Second, we have seen, substantial interest rate cuts this time around. I don't think it's actually trickling down to all the sectors. It's particularly not trickling down to the sectors that really need capital. So it might lead to more of a divergence between the haves and the have-nots. So, the discretionary side of consumption continues to get chased, but that is a potential driver of recovery in the next 6 to 12 months. But on the whole, in the absence of a big global upturn and in the absence of a big capex upturn, I think we need to moderate our expectations. And we've actually downgraded our numbers not just for FY20, where we are now expecting 4.9%, but even for financial year 21, where we've brought down our numbers to close to 6%. So I don't think this is, similar to, let's say, the 2016-17 cycle, where you actually had a V-shaped recovery. I think it's going to be a fairly prolonged period of bottoming out process. And what really worries us is that if you look at some of these survey and real activity indicators as they stand today, some of them are actually either close to or worse than the levels we had seen during the global financial crisis. And we are not in a global financial crisis. So clearly there are India-specific factors that are causing a significantly larger than expected decline. And unlike 2008-9, where you had a coordinated global stimulus that led to a V-shaped recovery globally, that is also not going to happen. So we do need to be prepared for a fairly long period of sluggish and below trend growth. I think that would be my key message.
Well, thanks so much for joining us this morning and talking us through your outlook when it comes to growth and the current environment.